Welcome to Candlelight, where price is a mechanical function. In this video, I want to go over just how stupendously hilarious a statement like this is. Oh, trading and investing, be careful with that. That's some high risk stuff. You can make a lot of money or lose a lot of money. That's just hilarious to me because it doesn't make any sense. There are fundamental rules of thumb when it comes to entering the market, and there's essentially three of them. One, you always trade with a stop loss or an order that's going to take you out of a position. Second, you position size. So every trade that you take, every position that you go into, you only risk 1% of your portfolio, never more. And third, every position that you enter, you should expect to make or plan to make at least 3 times more than what you're risking. It can go all the way up to 10, 20, 30, it doesn't matter, but at the very least try and make at least 3 times more. So you always trade with a stop loss because for the same reason that you would never buy a gun that doesn't have a safety on it. If you're going to expose yourself to the market and if something goes really wrong, some news event or something like that, you don't want to be in a position where it's going against you. You want to have an order already there that's going to take you out in case of anything, and that way you define your risk, which is 1% of my portfolio. I'm not going to lose more than that, period. And every trade is exactly the same. Every time you go into it, you're going to risk 1%. No matter how large or how small your entry point is, or your hopefully demand zone if you're going long, or supply zone if you're going short is. And then with position sizing, if a zone is big, you put fewer contracts or fewer shares on there. And if a zone is small, then you can pack on more, and that way you're always risking per trade 1% of your portfolio. Position sizing. So loving your little losers is what keeps you alive. It's what loving your little losers pays. You're gonna be wrong in the market. Being wrong is essentially overhead. You're gonna have losses. You're not gonna be right all the time. In fact, you can be wrong half the time and still make a very decent sum of money, because if you make at least 3 times more on your winners than on your losers, half the time you're making 3 times as much, even shooting a 50% success rate. So love your little losers. It's okay to be wrong. It's part of it. But when you're wrong, don't have it cost you anything. So I got 2 examples I want to show you, just some very simple trades. So let's jump into it. All right, this is Chevron stock. My left-hand chart is a daily chart. Every candlestick represents 1 day's worth of price action. The center chart is a 240-minute chart, so 4 hours. And the right-hand chart is a 60-minute chart. All of Chevron, or they all 3 represent the Chevron stock. I want to be going over a trade here and a trade here. Now there's plenty more in the meantime. It's not like, over this whole entire lapse of time, there's just two shots, but these are just 2 really simple, easy ones I can explain to you. Let's go over the first one. And the first one I want to show you a trade that you'd be taking in an uptrend. Okay, so this is a trending trade. This one is going to be done on a 240. Right here you have a rally ballistic movement out. If there's a gap, treat that as a very large, or treat that as a candle. So you have a rally and movement in. This is where you'd buy, right at the, let me make this even bigger. Right here you buy, and then the red line is your stop loss. That's an order to take you out if you're wrong. And if you have, let's just say $100,000 in your account, you would risk $1,000 on that trade, just 1%. Your stop loss keeps you from, taking on a massive loss if price continues to go to the downside. You're going to be wrong sometimes, so if you're wrong, let it cost you nothing. What you can make on this trade is significantly more than your 1%. This origin of this drop, that's your, let's just say, target 1, and the origin of this whole swing is up here. Let's just say that's target 2, right? But I prefer to trade at I prefer to let price go, because sometimes it goes a lot further, like it did all the way up here. And I put a trend line on. It would be from right here to right here. And at the break in my trend line, I cash out, which is why I put these yellow squares, or the top of these yellow squares right here, because that's kind of where I would exit. Now again, you can cash out a lot higher, and there is a way to do that, but for the sake of this explanation, let's just keep it really simple and say there's an uptrend. If it breaks your uptrending trend line, then you cash out. Let's keep it really simple. So you're going to risk 1% of your trade, and the same ratio, so 1% now to the upside is every single box. These boxes are the exact same size as this. You're now up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10% if you cash out here. So let's just say you shoot a 50% success rate. Half the time you're making 10 times as much. That means what you can get out of one right per every 10 trades that you get wrong, and you're still at break even. That's what loving your little losers does for you. If you're wrong, have it cost you nothing, because you can be shooting a 10% success rate and still hold on to your account. The other thing that really helps is this ballistic movement there. That right there is a pocket of air. The origin of this move, that's where supply exists. Now, if you're in an uptrend, like right here on this daily, you're in an uptrend, so you're expecting price to make a higher swing high. So when it falls, it should break this higher swing high and then continue to go, which is why you'd be very inclined to cash out a lot higher. You tack on another almost another 10, and within what I think it was 3 days, you already made 10% in 3 days. But you can make almost twice as much. But that's how you do low risk, by putting on a stop loss and risking only 1% of your account. High probability because you're trading low into demand in an uptrend, and high profit potential because your nearest supply zone, the first one, which it should break, already is giving you 1, 2, 3, 4, 5, 6% profit potential. Even if you cashed out right here in supply, you made a 6 to 1. Not bad. Half the time you make 6 times as much. That's a very good living. Another example, this one I put, so if you have a better perspective, again, in an uptrend, we're waiting for price to come back down. This demand zone here broke this downtrend, and that's where this is on a 60. This rally-based rally, ballistic movement out. When price comes back down, you want to buy in demand, and you put your stop loss 1 tick below that demand zone. If it breaks that demand zone, then it is no longer a valid demand zone. In an uptrend, demand should not be broken. Demand should be respected, and supply should be broken. Now, if you're shorting, supply zones should be respected and demand zones should be broken. But we're in an uptrend, so this demand zone should hold. And if it doesn't, then cash me out. I lose 1% of my portfolio. I love that. If I'm going to lose, let it be 1%. Because when I win, if you catch good, strong zones, then even here, again, let's just be really conservative and say we had a trend line here and we cashed out at the break of this trend line right here. Now, again, you'd be able to re-enter right there. This was another fantastic demand zone. So you'd re-enter again and catch that one. But that's beside the point. Even if you cash out at the break of your trend line, you're up 1, 2, 3, 4, 5, 6, 7, 8, 9% in 3 days. So that's not bad. And again, even target 1, which is the origin of the leg that put you into demand, is 1, 2, 3, 4%. Even if you cashed out at 4%, ratio of 4 to 1, let's again say that half your trades are losers and half your trades are winners. Half the time you're making 4 times as much. That's a steal. That's a very good living. So that's what loving your little losers does for you. It pays to love your little losers, and always trade with a stop loss. Never ever have a position where you're down 15-20%. That just doesn't make any sense. That's high risk stuff. And trading without a stop loss, that's gambling. And you don't do that. You play odds and you play probabilities, and you control and define your risk always. So I hope this was helpful. I'll see you guys in the next one. Take it easy.